Welcome back to Talk Tickers. If you are tuning in right now, it is because you are looking for the signal, not the noise.
Exactly. You want the substance.
Right. You are the serious investor who doesn't just want to know that a stock moved. You want to know exactly why it moved and what the actual mechanics are under the hood. So I'm your host, here to guide you through this deep dive. And joining me, as always, is our resident expert to help connect the dots.
It is great to be here. And we have a fantastic deep dive today.
We really do. Today, we are focusing on what I like to call the hardware backbone of the digital economy. We are talking about analog devices, ticker symbol ADI.
It's a perfect description, calling it a backbone. Analog devices is one of those companies that people, they often overlook it because it isn't flashy, not in the consumer sense anyway.
Right, it's not a consumer brand.
Exactly. They don't make the phone in your pocket. They don't make the social media app you scroll through. And they certainly don't make the electric car sitting in your driveway. But, and this is a massive but, they make the chips that manage the battery life, the signal processing, the audio, and the power that makes literally all of those devices actually function.
Without them, the physics of our modern world just doesn't cooperate.
It really doesn't. And today's discussion is particularly interesting because we are unpacking the Q1 fiscal year 2026 earnings results, which just dropped. We have a lot of data to sift through.
Yeah, let's set the tone right off the bat for you guys listening. The market reaction to this print was, it was extremely telling. We saw an immediate pop of about 8% in the pre-market session.
Which is huge.
It is a massive move for a company of this size. We are talking about essentially a large cap industrial tech stock here. 8% is a leap. Now, it settled down during the trading day to a solid 2.6% gain.
Closing around $346, right?
Correct. But that initial reaction, that immediate vertical line on the chart right at the print, that tells me the street really likes what it sees.
It absolutely does. And I think the key here for you as an investor is to understand that this isn't just a simple earnings beat. I mean, anyone can engineer a penny beat on earnings per share if they, massage the numbers enough or lower the bar sufficiently in the prior quarter.
We see that all the time, the whole lowering expectations just to clear them scheme.
Right. But what we are seeing here and what the market sniffed out immediately is a potential signal that the semiconductor cycle, specifically the analog cycle, has turned a major corner. We have been waiting for this bottom for a long time.
Basically since the post-COVID hangover began. Yeah.
Exactly, the inventory glut. And this points to the end of that.
So that is the main mission for our deep dive today. We live in a world that is currently just completely obsessed with the brains of AI. Everyone is talking about GPUs. Everyone is talking about the logic chips.
The NVIDIAs and AMDs of the world.
Right. But analog devices provides the nervous system and the vascular system. We're talking about power delivery and optical connectivity. Because without that, the brain is just a very expensive piece of silicon sitting on a desk doing absolutely nothing.
That is a perfect analogy. The narrative we are going to unpack today is a classic cycle turn with quality. We are seeing the bottom of the traditional industrial cycle, which has really been dragging on the sector, and it is coinciding perfectly with an absolute explosion in AI infrastructure.
It's a dual engine setup.
Yeah, and that is rare. Usually you get one or the other. You get the cyclical recovery or you get a secular growth story. Right now, analog devices is giving us both.
So here is our roadmap for you today. We're going to hit the headline numbers first. Just a quick summary to get everyone oriented on the results. Then we're going to go really deep into the AI data center explosion, specifically looking at the power and optical sides of the business.
I think that's where the alpha really is right now, understanding the physics there.
I agree completely. Then we will unpack the industrial recovery, which I'm calling the sleeping giant of this report. We have to address the one blemish, which was automotive. And then we will finish up with our not financial advice segment, where we pitch a wild, outrageous, but plausible trade idea based on all the facts we've just laid out.
Sounds like a comprehensive plan. Let's get into the numbers.
Okay, let's hit the headlines. First quarter, fiscal 26, adjusted earnings per share came in at $2.46. The consensus on the street was sitting at $2.31, so that is a solid 15-cent beat.
Which is roughly a 6.5% surprise to the upside.
Right.
And in this environment, a 6% beat on the bottom line for a mature industrial semi-company is significant. It shows immense operational discipline. But keep going on the top line because I think that's where the real growth story begins.
Revenue clocked in at $3.16 billion. Consensus was looking for $3.12 billion. So a slight beat there. But the truly important metric is that it is up 4% year over year. We're finally back to growth.
That return to growth is vital. For a while, we were seeing straight year-over-year declines as that massive inventory correction played out across the industry. Seeing a plus sign next to the revenue growth figure is psychologically huge for investors. It means the bleeding has officially stopped.
It really is a relief sigh for the market.
But you know what really stood out to me? The margins.
Oh, the margins were incredible. Adjusted gross margin hit 71.0%, and the operating margin came in at 44.4%. I mean, let's just pause on that for a second. 71% gross margin.
It's wild.
That is software-level profitability on physical hardware products. How do they even manage that?
Well, that is the beauty of the analog business model. These aren't commodities. If you're making standard memory chips, you're fighting a brutal price war over fractions of a cent. It's a race to the bottom. But analog devices makes high-performance, precision-engineered components.
Where the switching costs are incredibly high.
Right, and the value add is massive. If you are a company building a $1 million MRI machine, you do not cheap out on the chip that interprets the magnetic signal. You happily pay the premium to know it won't fail.
Because the cost of failure is astronomical compared to the cost of the chip.
Exactly. When you can command 71 cents of gross profit on every dollar of sales, you have an incredible amount of room to generate cash. And hitting a 44% operating margin means they are running a very tight ship on the operating expense side, too.
But the real mover, the thing that I think caused that massive pre-market spike, was the forward guidance.
The guidance was the star of the show.
Q2 revenue is guided to $3.5 billion, give or take $100 million. That implies a really meaningful sequential acceleration.
We are going from $3.16 billion in Q1 to $3.5 billion in Q2. That is a step function change. That is not just stabilization. That is the engine revving up.
And looking at the EPS guidance for Q2, they are calling for $2.88 plus or minus 15 cents.
And the margins are expected to expand even further. Operating margins are expected to hit around 47.5% on an adjusted basis.
47.5, that is elite.
It really is. It puts them in the absolute top 1% of hardware companies globally. And we should touch on the capital returns briefly. They hiked the dividend by 11% to $1.10 per share quarterly.
Which is nice for the income investor, sure. It's a nice little bonus.
It is, but you have to read the signal, not just the check. This is the 22nd consecutive year of dividend increases for them. Management does not raise the dividend by double digits, a full 11%, unless they are extremely confident in the long-term durability of their cash flow.
Right, you don't commit to that structural payout if you think the cycle is going to roll over again.
Exactly. Their free cash flow margin was a massive 28% this quarter. They are printing money, and they're telling shareholders, we expect to keep printing money regardless of the macro noise.
That's a great point. It's a massive signal of confidence. And just for context for everyone listening, ADI stock has rallied about 50% over the last quarter. It has significantly outpaced the broader semiconductor index.
The market was pricing in a recovery. It was hoping for it.
Yeah, and it feels like Analog Devices just walked into the room and handed them the proof.
They delivered the hard evidence. So the narrative shift here is fascinating. Let's unpack that.
Let's do it. Because traditionally, when people think of Analog Devices, they think old school tech. They think industrial machinery on a factory floor, maybe some car parts, maybe some 5G cell towers. Why are we suddenly talking about them as a major AI play?
Because physics is the new bottleneck in AI. We've spent the last 2 years completely obsessed with the logic layer, the GPUs that do the heavy mathematical thinking.
Right, the training clusters.
Yes. But as these clusters get exponentially bigger, as we move from training to inference, and as the models themselves get larger, the physical constraints of power delivery and heat management are becoming the actual limiting factors for growth. It's not just about getting the chips anymore.
It's about turning them on without melting the building.
Exactly. And the numbers reflect this shift. Revenue in the data center segment grew approximately 50% in fiscal 25, and it is actively accelerating.
Accelerating from 50% growth. That is almost hard to comprehend for an industrial semi company.
It is, and it's coming from two main buckets. The first one, which I think is completely under the radar for most retail investors, is automated test equipment, or ATE.
Let's dig into that, because ATE accelerated in Q1. Why is testing equipment suddenly a massive growth engine?
Think about the physical chips being manufactured today for AI. We aren't just making simple, flat processors anymore. We are making highly intricate 3D stacked silicon structures, high bandwidth memory, specialized AI silicon, chiplets.
The packaging is getting insanely complex.
Right. These
Right.
things are incredibly expensive to make and incredibly complex to assemble. You cannot ship a $30,000 GPU to a hyperscaler without testing it to absolute perfection. Because if it fails in the server rack, the downtime cost is huge.
So the testing itself has to become more sophisticated to match the chip.
Testing these chips requires massive microscopic precision. You need to drive electrical signals into the chip, measure the exact response, check the power rails, and do it all at blisteringly high speeds. Analog Devices provides the pin electronics and the parametric measurement units that go inside these massive testers.
Okay, parametric measurement unit. Can you explain that simply? Because it sounds like something from a sci-fi movie.
Sure. Think of it like a doctor's diagnostic tool, but for electricity. It forces a specific voltage or current into a single microscopic pin on the chip and measures exactly what comes back.
So it's looking for anomalies.
Exactly. It tells you if the connection is perfectly good, if there is a micro short circuit, or if the electrical resistance is off by even a tiny, tiny fraction. It validates the physical health of the silicon before it ever leaves the factory.
And the content per tester has exploded, hasn't it? It's not just a few dollars of analog chips anymore.
Not at all. It is now in the tens of thousands of dollars of ADI content per testing machine. That is a massive bill of materials for them. And here is the kicker for the fab operator's energy efficiency.
Because testing takes a lot of juice.
If you are running a giant fab or a massive test floor, electricity is one of your top operating costs. ADI's new solutions are reducing energy consumption per test system by 30%. That is absolutely critical for the economics of semiconductor manufacturing right now.
So they are essentially selling the picks and shovels to the people who are making the AI picks and shovels.
Precisely. If you are bullish on the major GPU makers or the foundries, you implicitly have to be bullish on the equipment that validates their products. And Analog Devices is the beating heart of that equipment.
Let's move to the second bucket in the data center story, which is power management. This is the vascular system analogy. If the GPU is the brain, this tech provides the blood flow.
It is a vivid image, but it's physically accurate. Here's the core problem in modern computing. Data centers are trying to shove more and more electrical power into smaller and smaller physical spaces.
Rack density is going through the roof.
Right. And moving energy across a data center at low voltage is incredibly inefficient because you lose a ton of power to heat. It's just simple electrical resistance. So the industry is shifting to high voltage distribution. They are moving to 48 volt and 54 volt architectures across the board.
And this is where ADI's tech steps in to manage that flow.
Yes. They are winning massively in what is called vertical power.
What exactly is vertical power? How is that different from what we've always done?
Traditionally, the power delivery modules, the things that step the voltage down for the chip, sat horizontally next to the processor on the motherboard.
Right, you see them clustered around the CPU socket.
Exactly. But that takes up incredibly valuable horizontal real estate, space that you could use for more memory or faster interconnects. Vertical power means engineering the board, so you stack the power delivery directly underneath or over the processor itself.
Oh, wow. So you are literally stacking the voltage regulators on the z-axis.
Yes. It saves a massive amount of lateral space, and crucially, it reduces the physical distance the electricity has to travel to get to the silicon, which drastically reduces power loss. But the engineering required to do that without completely melting the board is immense.
Because if you stack power, you naturally stack heat. You are concentrating thermal energy in a very tight area.
Exactly. You are creating a thermal nightmare if you do it wrong. But ADI's chips are efficient enough to handle that high voltage conversion without overheating the package. The company noted they recently shipped smart power stages to their first vertical power customer.
That is a huge milestone. It means the technology is moving out of the R&D lab and into actual commercial deployment. They also mentioned accelerating the adoption of intermediate bus converters. Let's break that term down for the listeners.
An intermediate bus converter is basically a highly intelligent step-down transformer on a chip. It takes the 48 volts coming from the main rack power supply and steps it down to an intermediate level that can then be fine-tuned for the specific processor. It does the heavy lifting of voltage conversion.
And if that flow stops, or even if it fluctuates by a tiny percentage,
the GPU crashes immediately. Or worse, the silicon gets physically damaged by a voltage spike.
And they talked about protection solutions too, right? The hot swap controllers.
Right. Think about a massive hyperscale data center. You can't just power down an entire server rack to replace one faulty power supply. You have to pull it out and plug a new one in while the whole system is running live at full compute load.
Which sounds incredibly dangerous.
It is physically dangerous. If you plug a high voltage component into a live high-draw system without protection, you can get a massive arc flash. You can literally blow up the equipment or start a fire. Analog devices makes the hot swap controllers that manage that electrical connection safely.
It acts like a gatekeeper.
Exactly. It slowly ramps up the current so there's no spark, no surge. It is totally non-negotiable for safety. You literally cannot build a modern AI data center without this physical protection.
So the takeaway for the investor is, if the brain dies without blood, the GPU dies without this advanced power management.
Correct. And then you have the third leg of the data center stool, which is optical connectivity, the nervous system of the whole operation.
This is the major shift from copper wires to light, right?
Yes. As AI bandwidth speeds go up, copper wires have to get thicker and shorter, otherwise the signal degrades to noise. Eventually, physics just says, no more. You can't bend a copper pipe that thick inside a server rack. So data centers are rapidly replacing electrical switching with optical circuit switches, or OCS.
Now, analog devices doesn't make the actual laser itself, do they?
No, they don't make the physical laser. They make the silicon control loop around the laser, the digital signal processor, the DSP, and the photodiode signal chain.
Okay, explain why the laser needs a control loop.
Think of it this way. A laser is essentially a wild animal. The beam drifts with temperature changes. It drifts as the component ages. You need a highly sophisticated electronic control system that constantly monitors the light output and tweaks the power instantly to keep it shooting exactly where it needs to go at exactly the right frequency.
And ADI provides that microscopic precision control.
Yes, and the impact of doing that well is higher data speeds, much lower power consumption, and a much smaller physical footprint.
Which is exactly what the big tech hyperscalers are screaming for right now.
It's their biggest bottleneck.
So we have this incredible multi-layered AI growth engine. But the elephant in the room, or maybe the sleeping giant of this earnings print, is the industrial segment.
This is a huge piece of the pie.
It is nearly half of their total revenue, 47%. And for the last year or so, industrial has kind of been a dirty word in the stock market. It's been in a brutal recession.
It has been a severe inventory correction. Customers overordered during the supply chain crisis, and they've been burning through that backlog ever since. But the Q1 results finally confirmed the turn. Industrial revenue was up 5% sequentially, and incredibly, up 38% year over year.
38% year-over-year growth for heavy industrial chips. That sounds massive.
It is a massive number. Now, we do have to be a little careful. Some of that is the comparison against a very weak quarter last year, the base effect.
Yeah.
But the key metric here, the one that really made my ears perk up, was the book-to-bill ratio.
Now, let's explain that one for the folks who might be newer to semiconductor metrics.
So book-to-bill is the simple ratio of orders coming in, which are bookings versus products physically shipping out, which are billings. If the ratio is exactly 1, you are perfectly matching supply and demand. If the ratio is above 1, it means your backlog is growing. You're getting more orders in the door than you can fill immediately. That firmly implies future revenue growth. And it was noted that the book-to-bill in the industrial segment is now well above 1.
Now, I have to play devil's advocate here because we've been burned by this before. Is this just customers restocking their shelves? We saw this in 2021. Everyone panic bought chips, the ratio looked great, and then we had a massive glut. Are they just refilling the warehouse?
That is the most critical question you can ask right now, and it was addressed very explicitly. There is absolutely no evidence of restocking.
None.
None. The assessment is that this is true demand, actual physical consumption. Customers are ordering parts because they are actively building machines and shipping them to end users, not because they are hoarding chips in a warehouse out of fear.
That is such a crucial distinction for you as an investor. If it's consumption, it's a sustainable trend. If it's restocking, it's just a sugar high that crashes next quarter.
Exactly. And if we break down the industrial sector further, aerospace and defense is hitting all-time record highs.
That makes sense. Geopolitical tension is driving massive defense spending globally.
Unfortunately true, but financially, it is a huge tailwind for these high reliability components.
And what about the broader market? Factory automation, healthcare?
The broad market industrial segment is showing very normalized ordering patterns for the beginning of an upcycle. But here is the massive upside, and honestly, this is probably why the stock popped the way it did.
Lay it on us.
While the test equipment and defense sectors are sitting at all-time peaks, the other two-thirds of the broad industrial segment are still 20% below their previous revenue
Oh,
peaks.
wow. So they are recovering, yes, but they have a very long way to go just to get back to where they were 2 years ago.
Exactly. That implies a very long runway for recovery. We aren't anywhere near the top of the cycle. We are just pushing off the absolute bottom. That gives institutional investors a lot of comfort that this growth trajectory can last for several quarters, if not years.
Okay, so industrial is officially back. Data center is booming. We do have to talk about the one ugly spot in the report. Automotive.
Yes. Auto was definitely the drag on the quarter. It was down 8% sequentially.
And the reason given was something called tariff pull-in unwind. Can we unpack that phrase? Because it sounds like bureaucratic Fed speak.
It does, but it's actually pretty simple behavioral economics. In the previous couple of quarters, automotive customers, especially those dealing with complex international supply chains, were extremely worried about potential new tariffs or escalating trade policies.
Right, geopolitical risk management.
So they pulled in their orders, they bought everything they could possibly get their hands on before the potential tariffs might hit and raise their costs.
Ah, I see. So they essentially bought Q1's chips in Q4 to beat the clock.
Exactly. They pre-bought their inventory. So now, sitting in Q1 and heading into Q2, they are sitting on that pile of chips. They are digesting it. They simply don't need to order more right now because their factories are working through the stockpile.
And there is a specific China factor at play here too, right?
Yes. Analog Devices has intentionally increased its exposure to the Chinese electric vehicle market, which long-term is a fantastic growth story because of EV penetration rates there.
But short term.
Short-term, Q2 always includes the Lunar New Year.
Yeah.
Entire factories shut down for weeks, demand naturally dips, so having more China exposure inherently amplifies that Q2 seasonal dip.
So the outlook for the auto segment is basically flat to slightly down for the coming quarter.
Correct. However, expectations for the full fiscal year were maintained. Total fiscal 26 automotive revenue is still expected to grow over fiscal 25.
That's a pretty bold stance given the rough start to the year.
It is confident. They are banking heavily on the second half of the year, picking up significantly as the inventory clears. And the structural silver lining here is that they are actively gaining market share in level 2+ ADAS.
Well, let's clarify that acronym, Advanced Driver Assistance Systems.
Right. Lane keep assist, adaptive cruise control, automatic braking. Even if total global car sales remain totally flat, the actual number of chips required per car is going up dramatically.
Because every new car needs more safety sensors, more radar, more complex battery management.
Exactly. That per vehicle content growth is actively offsetting the broader macro weakness in auto sales.
Got it. Now, let's pivot and talk about money, the financial discipline side of things. There was a really interesting discussion regarding pricing strategy.
This is always a very touchy subject in earnings. Are you growing a revenue because you were actually selling more volume or simply because you hiked prices on your customers?
Right. Is it just inflation masking stagnant demand, or is it real business growth?
The breakdown here is very revealing. Roughly 1/3 of the sequential revenue growth is coming from pricing actions.
Okay, so 1/3 price increases, 2/3 actual volume growth.
Roughly, yes.
Yeah.
But there is a specific, somewhat technical nuance here. There is a repricing of channel inventory happening in Q2.
What does that mean exactly?
It means the inventory that is already sitting on the distributor's shelves got its price marked up to reflect current market rates, and the company captures that incremental value. That is a one-time benefit. It adds about 50 basis points to their profit margins.
Okay, so that's a nice little one-off bonus for the quarter, but it won't repeat in Q3 or Q4.
Correct. It's a structural anomaly. But the vastly more important thing is that the remaining 2/3 of the growth is pure volume. They are physically shipping more units out the door. That firmly confirms the underlying demand story. It's not just an inflationary trick masking a volume slowdown.
And looking at the operational leverage, the actual factories themselves are running busier.
Factory utilization is improving rapidly, and when you own your own semiconductor fabs, which they do, they operate a hybrid model, but do a significant amount of internal manufacturing volume is your absolute best friend.
Because of fixed costs.
Right. The factory costs the same to run whether it's half empty or totally full. So the more chips you run through the line, the lower the cost per individual chip. That dynamic is exactly what pushes gross margins up to that elite 71.2% level.
And what about the inventory levels out in the distribution channel?
Channel inventory is extremely tight right now. It is sitting at a very lean 6 to 7 weeks of supply.
What does that signify for the rest of the year?
It creates a massive coiled spring effect for the stock. If end market demand suddenly spikes, let's say the auto market recovers 2 months faster than expected, there is absolutely no buffer left in the channel.
The shelves are bare.
Exactly. Distributors will have to rush to place emergency orders, and that revenue flows directly and immediately to the bottom line. It's an incredibly bullish setup for the back half of the fiscal year.
So putting this all into context for the investor listening right now, we constantly talk about finding quality companies. What specifically makes this a high-quality print?
Well, look at the historical data. In a typical semiconductor cycle recovery, you usually see revenue jump first. Demand comes back. But profit margins usually lag behind for several quarters because you have to spend money to ramp up expensive idle factories, hire new people, and pay overtime. Those costs eat into the initial profits.
But that isn't happening here.
No. Analog Devices is essentially defying economic gravity. They are growing top-line revenue and expanding their profit margins simultaneously right out of the gate.
Which brings us back to that operating margin guidance of 47.5%. It's honestly hard to overstate how incredibly high that is for a company that makes physical objects.
It is elite tier. It rivals SaaS software companies. And when you factor in a free cash flow margin sitting at 28%, this company is a pure cash machine. They are generating nearly 30 cents of pure, unencumbered cash for every single dollar of sales.
That funds the massive dividend, that funds share buybacks, and crucially, that funds the R&D to stay ahead of the competition.
Exactly. It creates a self-sustaining loop of dominance.
It really feels like they are proving to be the adult in the room in the tech sector. They aren't chasing the daily hype cycle with vaporware announcements. They are just quietly enabling the massive megatrends: sustainable energy, AI, autonomy. And they are doing it using physics-based physical hardware.
That is exactly their strategic positioning. They act as the necessary bridge between the digital world and the physical world. The digital world of AI is growing exponentially, yes, but eventually it has to interact with the physical world of voltage, current, light, and sound. That bridge is built by Analog Devices.
So for you as the investor, what are the specific catalysts you should be watching for in the next quarter?
I'd say there are 3 main things. Number 1 is bookings. We absolutely need to see that book-to-bill ratio stay above 1 in the industrial segment during Q2. If it dips back below 1, the whole recovery narrative falters.
Okay, watch the backlog. What is number 2?
Auto recovery. Does the second half of the year actually pick up the way they promised? Management really stuck their neck out on that full-year growth guidance. Now they need to deliver the numbers.
And number 3?
The AI spillover effect. Can they prove that this massive AI power demand is broad-based? Is it just them selling components to Google and Microsoft, or is it genuinely becoming a wider infrastructure build-out across enterprise and smaller data centers?
All right. We have thoroughly covered the numbers, the underlying technology, and the broader macro strategy. Now it is time for everyone's favorite segment, the part of the deep dive where we take off the sensible, prudent investor hat and put on the risk-taker helmet.
Ah, yes. The casino portion of the portfolio.
Exactly. This is the strictly not financial advice segment. Please, I'm begging you, do not do this with your rent money. Do not do this with your kids' college fund. This is a purely theoretical, high-risk trade idea designed to aggressively capitalize on the exact narrative we just spent the last hour discussing. We are calling this concept the thermodynamic strangle.
I have to admit, I absolutely love the name. It sounds incredibly painful.
Oh, it will be very painful for the people caught on the wrong side of the trade.
Mm-hmm.
Here is the foundational setup. We know AI demand is real, that is established fact. But we also know the constraint is no longer just getting the GPU. You can go buy H100s right now if you have the cash. The actual constraint is powering those chips without physically melting down the data center or crashing the local municipal power grid.
Right. Power density per square foot is the absolute bottleneck of the AI revolution.
And as we discussed, Analog Devices completely controls the vertical power stack, the high voltage 48 and 54 volt architecture that solves this exact thermal problem. But the broader market still treats the stock like a slow-moving, boring dividend payer. They call it a dad stock.
It's seen as safe, cyclical, and reliable, not explosive.
Exactly. So our outrageous pitch is this. We are betting on a massive structural re-rating of the stock. We are betting that Wall Street wakes up, stops valuing this company as an industrial cyclical, and starts valuing it as a critical AI infrastructure monopoly, exactly the same way they re-rated NVIDIA or Broadcom over the last 2 years.
And if they get a tech monopoly valuation multiple, the price target changes dramatically overnight.
Dramatically. So here is the long side of the trade. You go out and buy deep, out-of-the-money LEO PS, long-term equity anticipation securities. We're specifically looking at the $450 strike price for options expiring in early 2027.
$450. The stock is sitting at $346 right now. You need a massive 30% upward move just to get those options in the money.
Which is exactly why they are currently dirt cheap to buy. But if the market re-rating happens and they start trading at 30 or 35 times forward earnings strictly because of the AI power story, $450 is just a speed bump on the way up.
Okay, I see the vision on the long side. So what is the strangle part? What is the hedge that makes this trade outrageous?
The hedge is how you finance the EPS.
Yeah.
You fund this trade by aggressively shorting the pure play EV charging stocks or the legacy grid utility companies that structurally cannot handle high density power loads. You short the companies that are promising dumb power, the ones who think the future is just sticking a standard plug into the ground.
Oh, I see the underlying logic here. You are essentially saying that precision, managed power wins the decade and brute force dumb power loses.
Exactly. You go long precision and you go short dumb. If the massive AI grid upgrade happens, analog acts like a high-growth tech stock, not a boring industrial stock, and those cheap LAPS go up 10x. And if the grid upgrade doesn't happen, the dumb power stocks likely crash anyway because their entire business models are built on unrealistic infrastructure promises they can't deliver on.
It is a fascinating, bold strategy. It's effectively a macroeconomic pair trade entirely based on the concept of energy quality.
Energy quality. I really like that framing. But again, a massive disclaimer to you listening. We're laughing right now because this is extremely high risk, volatile stuff. Do your own deep research before touching options.
Absolutely. Do not blindly follow a podcast trade, but conceptually.
Yeah.
It aligns perfectly with the underlying physics of the situation we've analyzed today.
All right, let's wrap this up and consolidate the takeaways for the listeners.
To summarize the actual fundamentals, Analog Devices delivered a massive beat and raise quarter. The industrial segment is officially back. The sleeping giant has woken up and is showing true consumption demand. AI power management is accelerating rapidly and becoming a massive, undeniable revenue driver. And crucially, their profit margins are structurally higher than they have ever been.
The macro cycle bottom is firmly in the rearview mirror. We are looking strictly at the upswing now. Well, I want to leave you, the listener, with one final provocative thought to mull over. We spent all this time talking about data centers and heat management. But think about the extreme logical conclusion of power density. What if this incredibly precise thermal management technology ends up being the exact key that pushes AI infrastructure out of standard buildings entirely? What if the future of hyperscale compute isn't in a warehouse in Virginia, but underwater, or even in low Earth orbit?
Or extreme environment data centers.
Right, environments where ambient cooling is infinite, but where power precision is literally a matter of catastrophic failure. You can't send a technician to fix a blown power supply on a satellite. If ADI owns the precision power stack down here, they're going to own the infrastructure when AI compute leaves the atmosphere. It's just something to think about when you consider their long-term moat.
That is a wild but entirely plausible future. In a gold rush, everyone tells you to sell shovels. But in an AI rush, where the data mines are incredibly dangerous and run blisteringly hot, don't just sell shovels. Sell the specialized voltage regulators that keep the entire operation from catching fire. That is exactly what Analog Devices is executing right now.
I love it. Safety first, extreme profit second, or maybe both at the exact same time. Remember, nothing we discussed here today is financial advice. You have to do your own homework. Thank you for diving deep with us, and we will see you on the next earnings sprint.
Take care, everyone.